We have Dheeraj Agarwal now joining us, Managing Director at Ambit Investment Managers. Dheeraj, good to have you with us here. Thank you for your time. So I think we should begin with a quick view on the globe, and there are doubts whether this is going to be as nice and gentle and soft a landing in the US, because that is the big driver for the global markets because of data last night. But as someone earlier was pointing out, just one or two data points right now. We get the jobs data later today. But in any case, the overwhelming driver, dominating driver in India has been domestic inflows, which has helped us paper over everything else. So where do we stand according to you, Dheeraj?
So I think, so we've been all looking for a correction for a long time, but it's just not coming. And despite liquidity and flows, corrections do happen in the market. I mean, we also see one once in a while. I mean, last one was a little while ago. The last 10% correction was, I think, March 2023. So it's about 15 months ago. So one correction is around the corner. The trigger could be anything. And, if something goes wrong globally, it's quite possible that retail inflows temporarily can just take a little bit of a halt or a little bit of a pause. People might just actually want to wait for a month or two before they start deploying capital into the market again. And that's enough at this point of time for a correction to happen. US is decidedly looking a little weak at this point. In fact, contrary to what the popular perception is, 80-90% of the time, the first one or two rate cuts always results in the markets falling. And I think the logic for that is that central bankers are always supposed to be a little behind the curve, a little overcautious in when they start acting. And by the time they start cutting rates, it's already a little bit late for the economy, and some pain is already sunk in. And hence the market falls, and vice versa also, actually. So I wouldn't be surprised to see a slightly more meaningful correction in global equities at this point.
The meaningful correction has to come, right, at some point in time. It hasn't come yet in, I think, over 1.5 years. So perhaps the time is ripe. But what do you do in such a correction is the question. Do you buy the dip now? Do you wait for a bit? Do you raise your cash levels? Dheeraj, what's the best way to approach it?
I think that's, there's no one clear answer, right? It's horses for courses. So, I run a long short fund, so I will go short. That's one extreme. But at the same time, if somebody is running a completely long biased portfolio, you could possibly raise 5-10% cash, 10-15% cash, but nothing more. Because I think longer term, structurally, the story is intact. We are still in a rising market. It's still a correction. It's a correction. We have sort of forgotten about the fact that the corrections do happen, and we might be heading into one. And remember, NFT is just down 1% today, right? Yesterday, it was all-time high. So at this point of time, from an Indian point of view, correction hasn't even started. So a little bit of cash, a little bit of waiting, that's probably the right approach.
If we get a correction, Dheeraj, how much do you think we could see a correction? Because there's plenty of money waiting on the sidelines, and it's been gushing in. So what would your best guesstimate be?
10% odd, approximately.
Okay, from these current levels. And Dheeraj, I wanted your view on one stock. Any guesses for which one I'm going to ask you on?
It's 8% up today, so you know the answer.
But what's the view at current levels? Zomato has worked well for you. Every single time, whether you visited our studio or in fact we discussed, we tried to squeeze it in. Off late, you've not been commenting too much on Zomato. But at around 250 rupees, what's in the price? The best is in the price, or the best is yet to come?
You can't say best is yet to come, but the metrics for this company keeps improving. So, it's a huge market, right? And every time one thinks that, initially we used to think that food delivery is a value creator and Blinkit could be a liability, or Blinkit could be a little bit of a value destroyer. Looks like Blinkit is coming back very strongly at this point of time. It could be a value creator going forward. So different engines are firing. And off late, I've noticed in most of these delivery apps, including Zomato, is that they keep raising their delivery charges a bit by bit, and nobody's complaining. This is a very different India. This is very different from India of like 15 or 20 years ago, where $1 delivery cost increase, a $2 delivery cost increase, there were 3% price increase. People would just switch out from one to the other. I think people are just getting used to convenience, or people are getting lazy, whichever way you want to look at it. There's a lot of stickiness and network effect factor, and hence price increases are easier to pass through. So I think the story just keeps getting better and better. How long? Let's see.
Okay, I think there's a big market, right? But there are also many strong players in this market, whether it is Swiggy, Instamart, whether it's Zepto, whether it's Blinkit. So the fight is on, but I completely agree. I mean, people are getting used to this kind of treatment, this kind of service, right? Quick service, and it's only going to get better from here. But, I wanted your thoughts also on how to approach the auto sector, because there's a lot happening there. There's the Ola IPO that opens today. There is some weakness that we're seeing across most pockets, whether it's passenger vehicles, two-wheelers. Are you cautious here, or would you look for opportunities?
It's autos is a little bit of a mixed bag for me at this point of time. Few segments are looking slightly toppish. I think two-wheelers at this point of time is looking slightly toppish. On the other hand, tractors are improving, SUVs continue to do well. So there's so many diverse businesses within autos that it's difficult to actually take one common brush call within autos. Maruti did fantastic numbers 2 days ago. And the current global trend is becoming clearer and clearer that it's more hybrid rather than EVs. Certainly, Maruti is looking very smart in hindsight. So there are pockets of strengths and pockets of weaknesses within the auto space. So one will have to pick and choose.
Another space is a small space right now is wealth management. I think we've discussed this before. It just struck me because you said it's a different India, and and it maybe richer India in time as well, right? Stocks have done very well. The 3 or 4 which are actually now listed, standalone wealth management firms. Your view, Dheeraj?
This is again a space which has a long runway of growth. So at this point of time, if you think about it, only 8 or 9%, it's below 10% for sure, of domestic household savings stocks are in mutual funds, despite the fact that equity mutual funds have grown at a CAGR of 37% for the last decade. US is close to 40. I don't think we ever reach there. But even countries like Brazil, China, and many of the other Southeast Asian countries are closer to 20. So 10 going to 20, given there's large, and this is not annual financial savings, it's stock of financial savings or stock of household savings accumulated over generations and years. So there's a long runway of growth here. I think there was, and again, a bit of a Zomato kind of a story works here. We have come out of a phase 15 or 20 years ago where people didn't want to pay for advisor service. I think people are willing to pay now. I know of a few wealth management firms who are making it a success, even on the advisory model, which is saying that since we work for you, we won't charge the manufacturer, we will actually charge you, and people are willing to pay. So that's also a sign of changing India, that we are willing to pay for a good quality service and a service which is useful. So this is a multi-decade growth cycle, for sure.
Okay, this is a multi-decade growth cycle. Got that. Any other spaces before we let you go? Anything else where you see, certain pockets of strength? We are heading into talking about the real estate space in a bit. Your thoughts over there, or anything else that stands out for you?
So a few boring ones. There's a little bit of what I call the winds of change visible in the market at this point of time. The stocks and the sectors which have done really well in the last 3 years are going into a little bit of consolidation and a breather phase. Stocks and sectors which were gross underperformers of the last 2 or 3 years, few of them are showing signs of a comeback. So on the comeback trail, we have IT services. Most of the results this quarter were better than expected. Now they may be marginally better, they may be a lot better, but then all inflection points are tiny in the beginning. I hate to use that cliched term, but green shoots is what it is. There are signs of revival. Second is the rural demand story. A lot of companies' guidance in this quarter or commentary in this quarter with respect to rural demand has been very encouraging. So that's another space to watch. Third is chemicals coming out of, again, a multi-year consolidation. So there are these individual sectors and pockets which are coming out of long-term consolidation. If you notice, I didn't mention private banks. I'm still unsure of that as to if there is a big upside there or not.
Okay, we'll leave it at that. Thanks a lot for joining in, and have a great weekend. We'll touch base with you again later.